As we look at the boards on this Monday afternoon, February 2, 2026, BigBear.ai Holdings is currently trading at $4.90 USD, which puts it down about 0.14 or 2.78% during this intraday session. While most people are staring at the red on the screen and assuming this is just another small-cap tech slide, there is something much more calculated happening beneath the surface that the average retail trader is completely missing. Most investors see a sub-$5 stock and think of it as a speculative lottery ticket, but if you look at the recent institutional flow and the specific way they have been positioning themselves through various investing sites, you will see a story of tactical accumulation rather than a simple sell-off. The immediate insight that should grab your attention is that despite this price drop, the trading volume is showing a level of consolidation that usually precedes a major structural shift in how the market values government-contracted technology. The general expectation right now is that this company is struggling to find its footing after a lumpy 2025, but the reality is that they have finally finished integrating the Pangiam and Ask Sage acquisitions, which are finally starting to show up in the contract bidding process. Most people think of this as a secondary player compared to the big names, but when you look at how people are managing their individual brokerage accounts lately, there is a clear trend of shifting away from overpriced tech giants and toward these specialized firms that have a moat built on national security. It is easy to get distracted by the daily noise, but the real movement is in the underlying software-as-a-service transition that is happening behind closed doors. When we look at the recent daily swings, it is clear that the $5.00 mark has become a psychological battleground. We saw a high of $5.10 earlier today before it settled into this current range, and that volatility is exactly what institutional players use to shake out weak hands before a major catalyst. If you are using the Fidelity mobile app or checking your positions on the Robinhood app lately, you might see that 2.78% drop and feel an impulse to exit, but the volume tells a different story. We are seeing tens of millions of shares changing hands, which is significantly higher than the quiet summer months we saw last year. This suggests that the market is repricing the entire sector of defense intelligence. Institutional activity has been particularly telling over the last few weeks. We have seen organizations like Vanguard and UBS significantly increasing their stakes, which usually indicates that the smart money is looking at a 3 to 5 year window rather than the next 3 to 5 days. It is interesting to see how these big players operate compared to someone doing self-investing on a platform like SoFi Invest. While the retail side might be worried about the immediate intraday dip, the large funds are likely looking at the $700 million in liquidity and the cleaned-up balance sheet as a safety net. They are not buying the hype, they are buying the infrastructure. If you are currently looking for investment help or trying to decide how to balance your portfolio, it's worth noting how this stock fits into the broader tech ecosystem. While Nvidia stock and Apple stock often dominate the headlines and the top spots in Fidelity ETFs, companies like BigBear.ai provide a different kind of exposure. They are dealing with mission-critical data that cannot be offloaded to a public cloud. That specificity is what creates the tension between the current market price and the future potential value. The market narrative says they are too small to compete, but the contract wins in the United Arab Emirates and the collaboration with AD Ports suggest they are expanding their footprint in a way that the market hasn't fully priced in yet. The trading mechanics on platforms like Interactive Brokers show that the bid-ask spread has been tightening, which often points to a decrease in uncertainty among market makers. Whether you are using the Fidelity trading platform or looking through the Robinhood stock trading interface, you can see that the order flow is becoming more structured. This is not the chaotic selling of a company in trouble. It is the methodical rebalancing of a sector that is trying to figure out where the next leg of growth will come from. For those who invest online through an intelligent portfolio or use tools like Schwab Intelligent Portfolios, this kind of volatility is often handled automatically, but for those of us managing an interactive broker's account manually, it requires a bit more nuance. Let's talk for a second about what this company actually does because it is often misunderstood. They provide what they call decision intelligence. In plain English, they take massive, messy sets of data from sensors, satellites, and logistics networks and turn them into something a commander or a CEO can actually use to make a choice. They aren't just selling a chatbot, they are selling a system that helps predict where a supply chain might break or where a security threat might emerge. Their business model has historically been built on these large, multi-year government contracts, which is why the revenue looks lumpy. One quarter you have a massive win, and the next you're in a quiet period. That is the nature of the beast when your primary customer is the Department of Defense or the intelligence community. The recent acquisition of Ask Sage is probably the most underrated part of the story. It brings in roughly $25 million in annual recurring revenue and gives them access to over 20,000 government users. This moves them closer to a software-centric model, which the market usually rewards with much higher multiples. Right now, they are trading at a discount compared to the broader industry, partly because of the negative earnings per share and the memory of previous misses, but the expectation of continued losses is being challenged by the reality of these new higher-margin revenue streams. If they can show even a hint of approaching break-even in the next few reports, the current $4.90 will look very different in the rearview mirror. Comment below how many shares of BBAI you currently hold, or if you were waiting for it to cross back above the $5 mark before you jump in. I'm curious to see how many of you are using a more traditional Fidelity brokerage setup versus those who prefer the interface of the Robinhood app for these kinds of high volatility plays. When we consider the macroeconomic pressures, it is impossible to ignore how interest rates and government spending cycles affect a stock like this. We are in a period where the federal budget is under intense scrutiny, but defense and security are typically the last areas to see real cuts. This creates a floor for companies that are deeply embedded in the national security apparatus. If you are looking at online investing as a way to hedge against broader market downturns, finding these companies with sticky government revenue is a classic strategy. It's the same reason people keep a close eye on Tesla stock even when the consumer car market is soft. The underlying technology and the data they collect are the real assets. As we move into the final stretch of the first quarter, the outlook is defined by several key catalysts. We have the upcoming earnings report, where management will need to prove that the integration of their recent purchases is actually driving the bottom line. We also have the potential for new border security contracts, which have been a major focus of the current administration. If those contracts land, the expectation of a slow recovery will be shattered by the reality of a rapid scale-up. On the flip side, the risk remains that government spending could be delayed or that competition from larger players could squeeze their margins. This is the tightrope that small-cap tech investors have to walk. If you are using SoFi Active Investing or maybe a more complex interactive brokers platform to trade these swings, you know that timing is everything. The current price movement feels like a coiled spring. We have seen this pattern before where a stock consolidated just below a major round number like $5, testing the patience of everyone in the individual brokerage space, only to gap up on a single piece of news. Whether that news is a new contract or an analyst upgrade, the setup is there. Speaking of analysts, the consensus still sits around a $6 price target, which implies a significant upside from where we are sitting at $4.90 today. For those who are more into a hands-off approach, like using a SoFi Active Investing or maybe a more complex interactive brokers platform to trade these swings, you know that timing is everything. The current price movement feels like a coiled spring. We have seen this pattern before where a stock consolidated just below a major round number like $5, testing the patience of everyone in the individual brokerage space, only to gap up on a single piece of news. Whether that news is a new contract or an analyst upgrade, the setup is there. Speaking of analysts, the consensus still sits around a $6 price target, which implies a significant upside from where we are sitting at $4.90 today. For those who are more into a hands-off approach, like using a SoFi active investing or maybe a more complex interactive brokers platform to trade these swings, you know that timing is everything. The current price movement feels like a coiled spring. We have seen this pattern before where a stock consolidated just below a major round number like $5, testing the patience of everyone in the individual brokerage space, only to gap up on a single piece of news. Whether that news is a new contract or an analyst upgrade, the setup is there. Speaking of analysts, the consensus still sits around a $6 price target, which implies a significant upside from where we are sitting at $4.90 today. For those who are more into a hands-off approach, like using a SoFi active investing or maybe a more complex interactive brokers platform to trade these swings,